All right, and since the economy may drive the Fed, which of course the Fed may then drive stocks, let's talk about all of it. On set with us tonight is RSM Chief Economist Joe Brusuelas. Joe, good to see. We got to stop meeting like this.
I know.
I think our first interview was like 20 years ago. We were talking about that downstairs.
Yeah.
I don't know what that says about either of us. Either way, to Courtney's point,
yep.
We got retail sales, we got some retail earnings, CPI, PPI. I know you watch it all.
Yep.
But if you had, that's game time. If you had to pick one, the most important, what would it be?
It'd be CPI, and you want to go deep into the report this time. Market's going to ignore those top-line numbers because they're going to look a little bit like they have for several months, more benign inflation. But what happened over the last couple months is housing inflation finally turned over. After that year lag that the Fed widely advertised, well, it showed up. And if we continue to see that improve, owner-occupied housing consumption, well, the Fed's going to feel more comfortable that they're going to get to that 2% inflation target. And then the onus will really shift to, hey, the bias of risks is moved towards employment, and we need to start cutting at every meeting.
I think what you're saying is very important, and we should probably reiterate that. You effectively, and again, don't want to quote you back to you and tell me if I'm wrong. Are you saying to ignore the headline number?
I am, because you're going to get a 0.2. It's going to be a weak 0.2. But what the Fed's really focused in on is if indeed that inflation that stemmed from housing is really turned over. If it is, then we're not really worried about inflation now. What we're worried about is how quickly the labor market will slow. We think the labor market is going to add about 120,000 jobs on average through the remainder of the year. That means a little bit of pressure to the upside on the unemployment rate, but nothing that's going to break the economy.
Joe, thanks so much. So you mentioned the owner equivalent rent. I kind of want to drill down a little bit there. I would argue that my argument would essentially be that that portion of the inflation reading is a lot slower moving. You're not getting rents that are being reconfigured on a month-to-month or day-to-day basis as you are seeing a lot of the other issues. Is that enough to mask volatility in other areas of the CPI reading?
Because the weight of housing is over 1/3 in the entire CPI, it will offset not only the base year effects, but that month-to-month vol elsewhere. That's why policymakers and economists are focused on that like a laser as we head into the fall, because we all do expect just the economy, hiring, and overall inflation to continue to cool back to a much more sustainable rate, or the word you guys like to throw around, normalization.
Industrial commodities collapsing, right? You've seen nickel, zinc, copper, broad basket down some 20% since May. I think that also speaks to, and what's going on in yields. The market is ahead of the Fed.
Well, I'll let you guys talk about all the technicals, right? Because that voodoo that you do so well, it's not my thing. What I can tell you, though, is that we're going through a profound regime change. Over the last 20 years, anybody who entered the business only really knows zero interest rate policy, lower for longer. The shocks of the pandemic finally cleared the deck. We finally had a recession that cleared the market. And now what we're going to have is, well, no more leverage like we've had. We're going to have higher interest rates for longer, higher inflation, higher rates, structural changes around how we acquire goods from the external sector. Therefore, the areas of the market that have relied on massive leverage, like we started to see in wine this week, are all going to have their day of adjustment. Commodities, oil, private credit. It's going to happen because the economy is going to get a lot more sturdy or less fragile. In order to do that, we just got to go through this transition. It's going to take us a couple of years. And unfortunately, we're probably going to have another couple of weeks like we had this week. Look, a carry trade that notionally is $4.4 trillion. Leverage that up 7 times, you're around $30 trillion. It started to unwind in early July. We probably got a couple more weeks, and we're probably going to have a couple more stronger, difficult days. But in those commodity areas, I think that's one of the risks around the market going forward as that leverage gets, unlevered.
Tim?
Hey, Joe, this is kind of a philosophical question, but, in your economist sphere, it's important. And seeing as all we are is dust in the wind, I think we can get a little philosophical here. If you think about Paul Volcker, it was all about breaking the psyche of inflation. Why does the Fed need to move as quickly as I think you think they should move or is going to move? I can tell you as a consumer, I see prices going up on everything now. In other words, there's been inflation, but I see everywhere I turn, whether it's my parking garage, whether it's my local deli, whether it's my insurance, whether it's my mortgage, at least forget the mortgage, more even around just rates against maintenance on housing and whatnot. But to me, the whole idea of inflation is something that becomes systemic. And I feel like it's still systemic, and there's no rush for the Fed. And what's wrong with a little bit of recession? Is that crazy?
It's a recession we don't need to have, I think is what it is, Tim. Look, the price level's not going back to 2019 levels. In order to do that, we'd have to engineer a pretty steep recession and pretty high unemployment rates. My sense is that 2.5% PCE is functionally price stability. Therefore, the reason why the Fed's going to move is they want to preserve and protect the soft landing. Now, you guys out there who trade, to be honest with you, are at the front lines of this. If we have a recession, it's traders who get hit the worst first. Then you get the American household, precisely down market workers who tend to get laid off. Well, I hear what you're saying, Tim. We shouldn't fight the last war. This isn't Volcker's inflation war, and there's no need to choke inflation out of the economy and create a massive wave of disinflation. To me, that just doesn't make sense, and the trade-offs are worth paying, but I do get your point.